For those of us who have made it on time, I'm not going to keep everyone waiting much longer. So thank you all for joining us. Good morning and welcome to the first discussion amongst clients and friends with Alexander Forbes Wealth. Just by introduction, 2020 has brought about a tidal wave of uncertainty. I myself got married in February, honeymooned in Bali and arrived back to quarantine and going back to the office to pack up my belongings and get used to the new way of doing things from the comfort of my home, as we were just discussing. It is safe to say that this uncertainty has been prosperous for many, spending more time at home with their families, redesigning their factories to cater to a massive surge in PPE, or interacting with clients more efficiently through the various online platforms such as this. However, for many, this has come at the cost of their job due to the major retrenchments and shutting down of small businesses struggling with cash flow. In the case of markets, we saw a drastic sell-off in March due to the uncertainty. However, as quickly as it fell, it seems to have recovered. Hindsight being 2020 vision, we may have done things differently. However, markets are forward-looking, and with the ongoing theme of uncertainty playing out, less traditional investment strategies have become quite popular. It is for this reason we have asked Japie to host this discussion panel with regards to their latest opportunity to invest into the global markets and have capital protection on the downside, creating certainty in a world full of uncertainty. So on that, I'm going to pass it over to Japie, and I will be controlling the slides from my side.
Yeah, thanks. That's great, James. Maybe whilst you're just putting up the presentation, just to give you guys a bit of background. So I've been at Investec for over 20 years. We've done 125 listings over that 20-year period. And Graham and Grant have participated in a number of those. And what we've been very fortunate in that not one of the offerings in 20 years applies velocity. So we structure investments as opposed to just taking a market position. And I'm going to talk you through how we do it, what it does, and then get some questions at the end. So James, if you want to go straight to page 3, page numbering is right bottom. Yeah, just there. So what we have is the investors can buy into a company. It's the shares in a company. The company is called the Advanced Investment Holdings Limited. It's going into its second phase. How the investments work is it has a period of time. It's an investment for a term, 5 years, and it's in US dollars. The clients buy a share in a Guernsey company that's listed in Bermuda. The company's listed so that they can take out monies through asset swap, buy it on a foreign stockbroking account, buy it direct, buy it into like Old Mutual International wrapper, Glacier International wrapper, Momentum International wrapper, and so you can buy it direct or through a wrapper. What does the share do? It only has two main objectives. Firstly, I invest for 5 years in dollars, and I've got a capital protection. I'm going to explain the maths to you in a moment. If I'm wrong and the stock exchange crashes 50%, I get my $100 that I put in back. I don't lose my $100. Secondly, if I'm fortunate enough that the MSCI World type indexes that we've chosen here, we'll take you through the detail, if they rise, one participation in the rise of that index. It's for a 5-year term. At the end of 5 years, if the market's down 40, I get my $100 back. I can go buy the market now available at 60. If the market's gone up 40, you'll be approached by Investec and asked, do you want to keep your shares or do you want to sell your shares? If you retain your shares, you have no capital gains tax, but your capital guarantee moves to the high water mark, to 140 or 150, wherever the market ended. So, good daily price, good daily liquidity, can sell the shares anytime during the 5 years at the prevailing price. If you sell early, the capital guarantee is not effective. It's a guarantee is effective if you keep to maturity. And the minimum is $13,000. So, how do we do this? We get $100 from all the subscribers. It's in US dollars. We go to Investec. We've made arrangements with Investec that they will issue us with a note. It's called a credit-linked note, and it references the South African government's 5-year obligations. And I'll talk to separately in a separate a separate input at the end of the main presentation. And what happens is that the South African government trades in world markets at about 2.8% above the US government for 5-year risk. We add to that what Investec's prepared to pay us for 5-year deposits, which is 2.2%. And if you think of a fixed income instrument, we've got something paying 5% in dollars, the 2.2 plus the 2.8. So what we do is we take 79% of the 100 capital that we got, and we buy those notes into this Guernsey company. And the 79 grows to 80, 81, 82, 83, and matures in 5 years' time at exactly $100. That's what gives us the first capability to say that we're protecting the capital. So on day one, we got 21 left over, 100 less 79. We put aside roughly 6% for 5 years of fees, costs, and expenses. That's for Alexander Forbes, for Investec, for the lawyers, the auditors. Cost me £2,000 a year, James, for 100% tax exemption in Guernsey. The majority of these companies traded a billion rand and bigger. They're very big companies. And so what happens is that we've got 15 left over, 21 less 6. And with 15, we go to 6 big banks. The banks have to be rated S&P A or better. So you're talking Japie Morgan, Bank of America, Credit Suisse, these big banks. And we buy a call option. A call option is a very simple instrument that you pay a premium. And if the markets rise, they've got to give you 1-for-1 what the market rises on based on the 100. Okay, so if the market over the 5 years does minus 40, then the debt instrument still matured at 100. So you didn't lose your money. If the market goes up 40, the option pays out 40 because that's how much it went up by. Add it to 100, you've got 140. The 6 of costs, fees, and expenses are amortized once a year, and they amortize down to 0. So at the end of the 5 years, there's none of them left over. So if we take it one page forward, so to show how would such a share have done for me had I held it historically, we've done a 5-year rolling return. This portfolio of indices is 98% the same thing as the MSCI World All Country. And we've done a 5-year rolling return on that graph. You can see to the left-hand axis, you've got where 0 is, and then plus 50, and you've got the percentage 5-year returns on the left, plus and minus, and then along the bottom, you've got the end of the 5-year term. So the first 5 years, which started in 1972, would have ended in 1977. And you can see initially it was going through a poor patch. Normal investors would have lost money. So if you look at that, normal investors would own the black and the blue. So ordinarily, as you know, if the stock market's down over the 5-year, the normal investor's losing. Whereas here, the simulation shows you that if the market was down, you would have just got 0 because you didn't get a profit, but you got your capital back. If you look at the summary, it shows you that in that entire 48-year period, roughly 20% of the time, the market ended down over a 5-year. And you see, James, this is the normal problem that we have as investors. We don't know whether it's going to go up or down. But if you're unlucky and you hit a time like now that it goes down when you've invested, obviously with very low interest rates at the bank and in bonds, the recovery of your loss is extremely. But if you invest in something where you can't lose your capital, then if it goes down and you got your capital back, all that you would argue is that I lost the interest that I could have got at the bank, which let's say is 0.5% before tax. Now, if you'd owned this share historically, we don't know what the future holds, but what we can say conclusively is that historically you would have got an average of 8.5% in dollars per annum, a best of 32 per annum in dollars, and a worst of 0. So specifically against how low the interest rates are now, that stands us in good stead. I think coming to your point, James, about where the world's at, what we believe at Investec is that there's been a lot of money pumped into the system. There's a lot of cheap money in the world markets, pumped in there by the US authorities, the European authorities, the UK authorities, all the authorities. Now, cheap money has one of two outcomes. Either you buy at the wrong time and it ends up in tears because it all crashes. The prices were inflated when you bought. Or secondly, those cheap money chases the much higher valuations, like we've seen with the FANGs, and we've seen with certain markets. 3-4 years ago, people were calling it that the markets are too high. Guess what? Last night they hit new highs. You can't say with markets, but what we know is that if there's a crash, it's better to have had cash. And that's what we come from in this offering, is to provide the protection in case it goes bad. And my background is I'm an ex-Zimbabwean farmer, and I can assure you that having protection in dollars is a very valuable thing in the African continent. Okay, so if we page forward, just looking then at what would the payoff be for such an offering. It's extremely simple. At the top there, you can see that if the market goes down 50, you still get your 100. The reason you're getting your 100 is because the debt instrument matured at 100. It had nothing to do with stock exchanges, that asset, the debt instrument. Secondly, if the market goes up 40, you make 140 because you paid out from the option and 100 from the debt. And then that picture is infinite. There's no limit on how much you can make. You see what we have in the world? We've got all this trillions of liquidity that's been pumped in by these authorities, initially because there was no growth rate, and then with COVID. So what you as an investor should want is not to have a limit on how much money you can make from shares. And that's what this affords you. The indices that we've selected are specifically done because it's 40% S&P 500, 30% Europe, 15 Nikkei, and 15 emerging markets. I think even supported now by Biden's selection. What you want is that you want to be careful of the very expensive shares. Those are called the FANGs, the tech stocks. And that's why you'll see we've cut the S&P 500 back slightly from its world exposure to a 40% exposure. Recognizing we can always be wrong in life, and if we're wrong, we've got 100% capital protection. So, there. Sorry, I've got a dash out here at my house in Oman. Is that very unhappy with the pigeons, so please excuse the barking if you hear that. Okay, so let's go on there, James. So just taking us to the next page, page 6. What you have is, we just wanted to have a look because lots of people have tended to historically, James, as you know, use unit trusts as the way that they buy their equity exposure. To just give an idea, how would such an offering compare to the major unit trusts in the world that target equities, equity unit trusts? And we did an assessment over the last 1, 3, and 5 year of the 816 top Morningstar unit trusts in the world that manage equities. And you can see there, close on 50% would have beaten such a product if you take their total returns and you take off their total expense ratio, because this offering is after fees, costs, and expenses. You remember we put the 6 aside up front. Okay, so if it was a crash, a minus 40 type period, because we've had a bull market in the last 5 years, then obviously such an offering would have beaten all those unit trusts. Just give me 1 sec here. Okay, my apologies. Okay, so that just demonstrates the power of having protection, because if it's going well, this thing will do as well as the average unit trust. If it's going poorly, then obviously it's not the unit trust manager's fault. But if the market goes down 40, you can imagine you're going to take quite a significant loss. So if we page on to page 7, just to give some idea of the 125 listings we've done over the 20 years, 75 have completed their investment term, and we've only had 5 where we returned capital. The other 70 were all profitable. I want to show you one of the 5 when the proverbial pawpaw hits the fan. This is a graph of the world index, and the light blue patch takes up the time where we had the 2008-9 crash. We had a share in the market at that stage, same as designers today, and the market was 44% down at the end of the period. Our investors at that same date just pressed what we call the undo button. They got their £100 back in their account. The most important thing is if the market's down 40 or 44 and you can buy it, but you're armed with 100, not with a statement telling you you're worth 56. That means you've permanently, for the rest of your life, you've saved the 40 that you would have otherwise lost. And that's actually very, very important, especially if you're getting to 55 and older as an investor. Preserving your capital must become a very important attribute. And Warren Buffett will tell you, rule number 1 is protect your capital. Okay. Rule number 2 is, James, don't proceed until you recheck rule number 1. Protect your capital. Because if you've got enough capital on retirement and you're sitting fairly well, the one thing you must be careful of is a lot of that money. Okay, so that's where we come from in this offering. So if we page forward to page 8, just to show one of the things that impacts the pricing of the offering is the volatility. So how it works with call options and put options, all options are driven by volatility. If the volatility is high, the price of the options is expensive. This graph might be interesting for guys who don't look at volatility on a daily basis. If you look to the far right there, James, you can see how the volatility shot up with the COVID. You mentioned the COVID, when the COVID hit, when stock markets crashed, the volatility shot up and have subsequently come down somewhat. But interesting enough, if a client says, but why don't I buy an ETF? Then I get the market and I get dividends, but you would take risk. If you didn't want to take risk, you would have to buy a put option. And a put option, as we've indicated there, would cost 20. So if an investor wanted to simulate this offering by buying the market and then buying protection, like you buy car insurance, household insurance, medical aid, life insurance, you could only get 80% of the upside, not 100% of the upside. Okay, so if we take it forward, just to show you the big advantage of the structure being a share in a company, you look at this graph, very interesting, 120-year track record of assets done by Credit Suisse. The top half is Credit Suisse's yearbook. You can see equities gave 9.6 per annum average over 120 years, MSCI World Equities. That includes dividends. So if you take the dividends out, say 7.3 per annum. Bonds historically gave 4.9 and bills cash 3.7. But you see where we at is this location in the world as we speak. And that is that the interest rates are actually where we are on the swap curve. If you look at the bottom here, between 15 basis points and 40 basis points up to 6 years. And this is the issue. If you take your money overseas and you put it in a bank, you earn nothing. If you put it in bonds, you earn near nothing and you take massive risk. You know what it's like, James? If the interest rates rise, you lose on your capital in bonds. And then lots of people have historically thought, what I'll do is I'll protect myself. I'll buy balanced funds. I put it to you that balanced funds timing now is not great. If the market goes down 40% and you owned a balanced fund, you'll still lose 20 because for a fund manager has half your money in shares. And on that half, you lose 40. So you lose 20 in total. It's better to lose nothing. Secondly, if the market goes up 40, you'll only make 20 because the fund manager's only got half the money in equities. So here, with the call option structure, you're getting 100% of the upside, i.e. 40, not only 20. Now, you might say, why don't I just buy normal equities? Well, you can, but obviously they're hugely risky because the timing is very difficult to get right. And we know that old adage, can't time the market. It's very difficult. Okay, so if we take this forward, I mentioned up front that we use a share structure. We use a share structure specifically because if you look at this, this is one of our other shares called the Optimal, just to show you historic share performance. It started in 2004 to the far left bottom when the rand was 11 rand 16 to a pound. It was a pound share, started at £1,000. 5 years later, at roll number 1, we go to the shareholders and we say, James, do you want to keep your shares or do you want to sell your shares? Market had gone up 35%. You decide you don't want to sell your shares. You don't need the money yet. We lock in your performance because the bond pays out 100, the options pay out 35. We add the two together. The new one for the next phase is 135. So every 5 years, you can see these clients locked in 13, 17, 19, 47. Subsequent to that, last year, markets went up. Markets got smashed with COVID and have recovered back up now. So these shares are now worth £2,116 per share. And this company, to give you an idea, is 1.5 billion in size, and we only had one shareholder who sold through COVID. There's another big advantage of this structure. If you buy shares and you've got a future date where you know you're going to get your capital back, if it's all is in bad shape, then you don't stress, you don't panic when the market goes down 15, 20, 30 like we had with COVID. Because if it doesn't recover, you're going to get your capital back. Whereas a normal investor who's going to face that loss, it's horrible because they're always worrying, and you're supposed to be enjoying your retirement and supposed to be going into retirement with, you know, some security, and now you're worrying what's your capital going to be like if you get wiped out. Okay. So one day when you sell the shares, you only pay tax on the profit in the foreign currency. So let me just demonstrate to you. If you bought a share like I did, I buy all these shares. I bought it £1,000 at 11 Rand 16. That means my cost price in Rand was 11,116. And today at £2,116, if I sold, I'd only pay tax on the difference between £2,116 and £1,000 purchase price. So I'd pay tax on 111% in pounds. If I'd had a Rand investment, like James, a Rand feeder fund, or Naspers, or Richmond, or foreign shares listed on the JSE in Rand, I'd pay tax on the profit in the Rand, which would mean I'd sell the shares now for 45,000 Rand a share, having bought for 11, and I'd pay tax on 300. Okay, so there's a very, very significant difference in tax. But the beauty here is you don't pay tax until one day you sell the shares. Now, Grant and Graham have got clients who own these shares of ours, and you literally just kick the tin down the street, because the 120 track record of the world shows you the best asset by far is shares. Okay, so you just keep owning shares, but just in case you're wrong, in that time only, then you elect to have cash when you know it crashed. Okay, so that's very, very powerful. So if we take it forward, second last page.
Japie, I just want to second what you're saying there, because I think it's important that people realize that over time the Rand is going to depreciate. So
yeah,
capital gains is going to become an issue. You know, you sort of have a longer term view on your offshore funds, especially in this sort of environment. So the Rand will depreciate and your capital gains will become more significant. So having it in a US dollar or, you know, sterling currency, it does make sense.
Yeah, it's very valuable. In fact, that's the next page. If you just check down, we often asked what's the expectation for the Rand. Now, you know, the Rand's very volatile. So this was done a few days ago when it was 1640 or so. But the principle is the principle. The expected devaluation is about 25%. Okay, so if you for your long-term savings, it makes a lot of sense to have your growth assets overseas, because the markets we're targeting here would represent 99 of the world's 100. South Africa would be 1. Okay, so in other words, the growth opportunities worldwide are massively more than in South Africa from an equities perspective. So what we think makes a lot of sense, James, is to have the client's local requirements for cash and dividends and money market type instruments and preference shares, whatever, that would be in Rand, so that you match the liabilities in Rand. But if you want to grow your capital so that if you become 90, you've got enough capital in the last 5 or 10 years of your life, then this asset is fantastic for that growth asset, because it's equity centric. But just in case there's a calamity, you default to cash, knowing now that it crashed. Okay, because hindsight's a perfect science. So what I can mention to the audience is that I joined Investec 20 years ago with this idea, and we've now built a business from nothing to 22 billion Rand of structures. Having done 75 with 5 maturing and no losses. And also very importantly, we manage half the size of the entire South African hedge fund industry put together. All 137 hedge funds in the country put together manage only twice as much as what we manage at Investec, just on these structures. So they've been very, very efficient for our clients. So that summarizes this page. If I go to fees, maybe just to explain fees, the fees are all built into the pricing. So that 6 that we put aside is for an annual fee for Forbes. I don't think that you guys, James, charge an upfront charge. You have a discretion, but to the best of my recollection, you don't charge upfronts.
That is correct, yes.
Yeah. So for the clients, that's exceptionally fair, because unlike unit trusts, unlike share portfolios, these fees are all built into the pricing. So to explain it to you in very simple terms, if I drink coffee, I can have the milk inside the coffee. That's what this is. Or I can have the cremora on top. This is not on top, it's inside. Okay, so I put $100 on the table. If it crashes, I get that same $100 back in my hand, not $100 less fees, firstly. Secondly, if the markets rise, I get the growth based on the 100, not 100 less fees. And at the moment, that's very, very significant, because if you go back to the graph I showed you where interest rates are, they're so low that if you're incurring a lot of fees, it's very hard to beat the market, because the fees in dollar terms, become exorbitant. Whereas here, because they're built into the pricing, it's extremely efficient for the client as an investor. Okay, so if we close this offering, I'd just like to spend 2 or 3 minutes on the SA government, because I mentioned that you're taking the risk of the SA government. So that's this document. So if you page down, James, I'd like you to forward this to all the participants, but maybe I'd like to just focus on page 3. So just page this one down to page 3. Yeah, just there. So firstly, we know that South African institutions, banks, pension funds, Reg 28 funds, retirement annuities, all this lot, they have to own SA government bonds. That's, major asset in the local market. Foreigners that buy our bonds, we had a look, the top 40 international fund managers that buy our bonds, we just listed the top 10. On the left-hand side here, you can see the names: BlackRock, Japie Morgan, UBS, all these top institutions. Now, how do they judge the risk of South Africa over a 5-year period? Well, the South African government, as all other governments and all other bonds, trade in the world markets. And they trade at what we call a spread. That's an amount of risk above the US government. The graph that we've given there from Bloomberg, the white line, is South Africa. And our credit risk, I don't know if it's big enough, maybe you might make it a bit bigger. I don't know if that's possible, James, just the font size, just slightly bigger. Yeah, that might be better. Yeah. Okay, but in any event, when you get the document, you can see it. There you go. So we South Africa maybe slightly smaller. We'll make it. Yeah. But anyway, South Africa, we traded about 2.86%. There, I can see it exactly. That's beautiful. Turkey, for instance, if you wanted someone to buy Turkish bonds, they'd have to earn 5.28% in dollars per annum, more than US government. Okay. So South Africa is at 2.86. I'm not talking about Venezuela and Argentina and places like that. They're 11 and 13 because they bucket shops. They have big risk to government bonds. Now, James, if you just make it a bit smaller again, I'm going to go to the narrative below that graph. South Africa, by the way, just on that, you can see 5% was the highest it's ever been in 10 years in South African government debt. So why is it? So let's ask the question. Why is it that when we look at the news, we get all pessimistic about South African government, because obviously their PR has been poor, and it looks like they're bailing out SA, and it looks like they're really doing things which don't look like good management. The fact is, the foreigners who buy our bonds and who prepare to buy them and only earn 2.86% above US debt for 5-year paper, they recognize 2 things are important in life. One is the rules. How do you make sure that the guy has to pay you back, or the government has to pay you back? Now, in South Africa's case, that's enshrined in what we call the National Revenue Account. And how it works is that we've got the Public Finance Management Act, which is enshrined in the Constitution and which lines up with the best countries in the world as far as regulations and rules are concerned. In simple terms, what it says is that the government's obligation to pay back its debt and the interest on the debt is the first item in the income statement. It ranks ahead of general public wages and 16 million people that have to get a grant and contributing or helping out SOEs or anything else. Okay, so the South African Constitution and the Reserve Bank are very, very strongly positioned, very well put in place. With independence, we got lots of accolades because of our Constitution. A big part of that was because of how certainty we give the bondholders on the fact that they can be repaid. So the one thing that's cornerstone is the rules, certainty that you'll be repaid within the law. The second one is cash. Have you got the money to pay me back? So if you just page down 1, James, to the next page, we've done a summary here of how much the South African government needs to pay back. Maybe just make it slightly smaller so we can just show everybody the bar chart at the bottom. We start with the bar chart. This one. So at the bottom there, you can see we've highlighted how much debt South Africa has to pay back from now to 2052. And the dark color is the domestic bonds. That's like bonds in rand. And then the red is the foreign debt and the foreign bonds and foreign loans. Now, if you look at that lot, and remember, as an investor here, I'm only dependent on the first 5 years, not what the rating agencies rate, which is 20, 30-year liabilities. That's why basically what they're saying to us is, South Africa, if you don't sort out your affairs, in 30 years' time, you're going to be junk. But our rating agencies, they're going to work, they're going to tell you right now that you're risking to go to junk, so we rate you as junk. But as an investor here, you've only got a 5-year exposure to the South African government and to Investec. So the South African government, in total, over the next 5 years, has to pay back $4.8 billion. That's the red pieces. Added together with the loan that they took from the IMF for the COVID, you might remember that they took a $4.2 billion loan. And so that in total is $9 billion. But they've actually got, at the end of October, 7.5 billion of gold reserves and a further 43 billion of foreign exchange reserves. So that's the debt cover that they have, roughly 5 times to pay back within 5 years. In dollars and in gold, held overseas, not subject to South African rand risk, quite safely put away. We do acknowledge that obviously there's nothing in life that has zero risk, but our view is that in view of the fact that the government's well run from a reserve bank perspective, and they've got the proper rules in place, and that the parliament, very important, parliament can't change those rules. It's a constitutional, it's tied up in the constitution. And secondly, that they've got more than 5 times the debt coverage they need. That shows us why the foreigners are prepared to buy the debt at such manageable interest rates in dollars. The rand debt, which is the bigger part here in the dark color, sadly, the government can, what we say, print money. They can bring in prescribed assets, and they can just issue more bonds, and they can even force the pension funds, it's been mooted before, to buy their debt by bringing in prescribed assets. So a government worldwide hardly ever defaults on its own debt locally in their home currency, because it can just create more. Now, the thing is, James, our investors here have a dollar investment, okay? So if the government did that, if they printed money like they did in Zim, or if they bring in prescribed assets, or if they do any of those things, because they don't want to renege on their debt, they'll never want to renege on the debt, then it will result in the rand weakening faster than what that forward graph showed. For that piece, I've got a dollar investment. I'm sitting well. That's why you need to have dollar investments, for in case they don't manage it properly going forward. But we're not that worried as we speak. So, James, in summary, that's what I wanted to say. And if I could say to you that the main reasons why the clients like these offerings, there are 4 major reasons. Firstly, it gives me an opportunity to own shares in the world only if shares do well. Funny enough, we don't want to own them if they go down 40%. Okay? It achieves that objective. Secondly, I want to have a high reward for the risk I'm taking. I can get unlimited upside to shares, the best asset class in history, but without my capital at risk. Thirdly, I want fair fees and fees that have been included inside the offering, so that I don't lose money and then feel I've also got to pay a lot of fees. That's very well established here. Graham has had clients, and Grant have had clients over time. I own these shares. I think they do, at least I know that Grant does. And you feel fairly treated as the investor. And then very, very importantly, because of most of our sort of, let's say, group age, we want to be able to sleep at night, and we want to be able to do well if it does well, but we don't want to take the pain of the capital losses in our foreign assets. And that's it in a nutshell, but I'm very happy to take questions.
Japie, thank you very much for that. I don't know if anyone does have any questions. They could just unmute themselves and they can ask away.
Hi, James. I actually put out a question in the chat. I just want to understand something. So guys, thanks, and thanks, Japie, for the presentation. Just if I could play the scenario out, I put in $100 on the structure, and in 2 years I want to sell out. At that point in time, and there's two scenarios. The first one being the market has gone up, so my $100 is now worth 120. The question is, one, how liquid is it for me to then get out of and sell? And the fact that the market's worth 120, what will I net after penalties and interest, etc.?
Okay, very good question. So firstly, just to appreciate how the share works. So on day one, we put that 79 in the debt, and that's just going to grow gradually to 80, 81. So in 2 years' time, just that asset, just it would have grown by 5% a year. So make it it'll be 87. That one, which is growing from 79 to 100, will at that stage in 2 years' time be worth about 87. Now, if the stock market, depending what the market's done, if the market's done 20%, then that 15 would probably be worth about, just going to take a stab here, you'd be able to sell your share at about 114, 150. You wouldn't get the full 20 because you're only 2 years into the 5. But you sell it at a slight discount to that. There's an early redemption fee of 1.25. So that would be the only fee that you would incur. And that would be only if Alexander Forbes didn't have another client who is prepared to buy the shares from you. We've sent around the secondary stock. How it works is that first layer of sale, willing buyer, willing seller. You've got another investor within Alexander Forbes who's prepared to buy it. So James, you just put Peter onto buying those shares. No costs. There's no fee involved. You just transfer the shares from the one person to the other, and the seller gets paid out. There's a daily price, and it's daily liquid at that price. Now, secondly, there's no buyer. You can't find a buyer within your Alexander Forbes client base. So Investec says we'll buy it from you every day and any day you want to sell at 1.25% below that prevailing price.
Okay,
thirdly,
so it's very liquid.
Yeah, so thirdly, what happens is that Investec says I've got a $5 million like kitty, like a cash which I can use to buy shares. To give you an idea, today on a $700 million book, I've got about $40,000 of stock only. Very few people, in our experience over 20 years, only 1% of people ever sell early. But I want to highlight for you, say the market in 2 years' time has gone down 50. Let's be very severe here. Let's say stock market crashes 50% within 2 years. The first asset, the 79, has grown to 87. It's got nothing to do with stock exchanges. So it's not affected by the fact that the stock exchanges crashed. Okay? So that's 87, the cash value. The second thing is that the fees and costs are put aside 6 upfront and they're amortized over the 5 year. So in 2 years' time, there'll still be about 2.5 of the 6 left over. So let's make it for simplicity 3, because it's been only 2 years out of 5. There'll probably be 3 left over. So now I'm at 90, 87 plus 3. And the equities, I'm going to say, let's assume they're worth nothing because the stock market's gone down 50%. I'm going to say that 15 we spent on the call option will be worth naught. It actually might be worth 1 or 2 because of the volatility is high now. But let's make it naught. So then my share price is 90. Stock exchange is at 50. I can sell my shares at 90, take my capital and go buy the stock exchange. I've just saved 40% that because I've only taken a 10 loss. I should have taken a 50 loss had I owned the market.
Yeah, got it.
You see it?
Got it. Yeah.
Okay, so
it.
what? Yes, but what's interesting there about that is the fact that in our experience, if you put your hand up to sell in 2 years' time, saying I'm prepared to sell at 90, okay, like we've just explained, then what happens? Another investor says, okay, so what I'll do, Silman, is I'll buy your shares at 90, knowing that they have to mature at 100. Okay. So that investor says, I'll take a profit of 10 on 90, okay, which is like 11, 12% yield. But they've only got a 3-year investment. We call that a synthetic money market. So what's very interesting over all 20 years, over 125 listings, is that the and to give you an idea, I've got 250 organizations in the world that market and sell this product, like Forbes is one of 250 organizations. And there are a lot of guys in all those organizations that have started to understand, obviously after 20 years, and understand the math. So they're continuously on the lookout for who's trying to sell. So we've had people trying to sell where they don't even have to sell at a discount. The supply and demand just says, I'll sell, but you know what, I'll take a lesser loss. But that, as I said, your worst case is 1.25 off the prevailing price.
No, thank you. Thank you for that. Appreciate
But it's
it.
100% liquid. Eh? So just to understand, you've got no problem here with liquidity.
Okay,
Why is
that was
that?
my main question. No, thank you so
No,
much. I
100%.
understand that.
I got that.
There is another question, but maybe I'll pick it up with Alex Forbes around the how much of this is interest related, but I'll pick that up with Grant. So
Oh, there's no interest related. So I can answer that for you. There's nothing that's interest. Because remember what we've done here is we've put a company in Guernsey. It's listed in Bermuda. That company, firstly, has got no problems with CITES, because it's not the UK and it's not the USA. So firstly, no CITES issues, James.
Okay.
No problem with CITES. Secondly, what happens, Sulman, is that the company earns the interest. The company makes the profit on the option, not you and I. I'm a shareholder in that company. I can tell you from a tax perspective, it's not a controlled foreign company. Okay, it's got hundreds of investors from all over the world. So very important, you only pay tax one day when you sell the shares. And you've got the ability every 5 years to lock in, or 4 or 5, depending how long the term is, to lock in your profits with no tax by just retaining the shares.
He answers all my questions. Thank you so much. James, I think Grant's not on the call, but I've dropped him an email. Kishore and I will hook up with him. So thanks for that so much. Guys, I've got to sign off. I really appreciate the time. Thank you so much. Cheers, everybody.
Thank you.
Cheers, Solomon. Thanks for joining us.
Thanks.
John, you have a question?
Yeah, I think probably covered largely by the last one, but you're thinking of an investor becoming deceased during that 5-year period. I guess the forced sale would really just be treated as to take your chances as to how the market stood at that time, or the estate would take its chances. Is that correct?
No, you've got more flexibility. What happens there, John, is that you can buy the shares in one person's name, say with John's name, or you're entitled to register it in up to 4 people's names. So what we find a lot of guys doing is they put it in their name and they put their wife as a secondary holder, and then say 2 adult children. So that you end up with you have to provide the figure, but the share register registers the fact that this has got secondary and third holders. So I pass away, my wife just carries on with the investment. She can, obviously, like all shareholders, choose to sell it, but she can choose to continue holding it. So she's not compelled, like let's say the market's down, she's not compelled to take a loss. She just waits till it matures. But in my estate, just from that perspective, in my estate, obviously my estate is wound up now, and that asset is included in my estate from an estate duty tax perspective, at the prevailing price. But that would be the same with my Microsoft shares and any unit trust I had in any other asset. But functionally, it's extremely easy for them to just continue. But even without that secondary buyer on the process, embedded there, your executor, just say you bought it in your own name only, and you didn't put it in a second or third party's name. The executor would just, there's in the admin procedure guide, which James will send you an admin procedure guide, it spells it out very clearly. But it just means that the executor of the estate provides the proof of death certificate and other documentation they need, and then gives guidance to the administrators what they want to have happen with the shares, i.e. keep them or sell them, or the beneficiaries will say, we need the money, or we're quite happy to wait, or whatever. But they'll be governed by with every estate.
Super, thank you very much. That makes it clear. Thank you.
Just one other thing I didn't go into much detail, but just to mention that, Graham, is that you know that the guys can buy these shares directly. So if you buy them directly, you can use your 1 million allowance, or your 10 million tax cleared allowance, or cash you have overseas, or you can use asset swap if you just got a trust or a company, or you haven't got any more allowance and you want to use, you can use asset swap. Investec's got asset swap available, and so have other organizations. I'm sure you guys got arrangements with asset swap providers. They charge you a small fee for using their capacity. The other thing is we've got clients who've got, like, let's say, a foreign stockbroking account, like with Credo or someone that they've got shares in that portfolio in a custodian overseas. You can add it, onto foreign, because it's got an ISIN number, it's got a Bloomberg ticker, it's like any other share in the world. Lastly, you can put it, if you have clients who use, for instance, Glacier wrapper, like they want to have all the assets in a wrapper for estate planning, or Old Mutual, or Momentum, all three, you can just buy it straight into that wrapper. In that instance, you would have the wrapper fee, which you agree with the provider, let's say Glacier as an example, and that the client would just put money in a cash to cover their fees. Because our offering we don't know if people are going to use that, so we don't cover if they charge a fee. So it's extremely flexible from, how I go in. By the way, this offering does close on the 4th of December. So that's like the closure date. And obviously you just need a copy of the client's ID and utility bill. You provide it to our admin support team and they confirm, yes, we've got everything we need from the client. And then they send you the bank details. And in the app form, what also happens there is you nominate your bank account. So say I've got a foreign bank account where if any payments got made to me, it goes straight into my foreign HSBC account. I nominate that account. If I don't have such an account, I can just nominate my local net bank account or Investec account. But if one day I want to get my money paid out overseas, I just advise the administrator that they must please pay my money into this account. But the shares in general, as you know, Graham, they don't pay dividends. So what we do is, because we know the client in South Africa is going to have to pay tax if they get a dividend. So we say it's better to have all your profit engrossed in the share price. And then only one day when you sell some shares, then you pick up a tax liability for however much you sold.
Japie, thanks so much. That's been so comprehensive. It's fantastic. And I must just say that, as you know, a lot of our clients just roll it over and keep on rolling it over because it's been so good. I've never had one person needing to use the liquidity option. It's just been a fantastic product for us, for a lot of our clients.
No, thanks, Graham. And the other thing that I can mention on this one, which is different to the previous ones, Graham, because this one has no subordinated debt. It's all senior debt. It's using the bank's normal deposits. It's very useful and can be offered at any point in time for a loan. So if a client just needs interim liquidity for a while, Investec's prepared to, and I'm sure the other banks will as well, to give you a loan, a rand loan for the shares. Because subordinate debt, like we used to use in the previous ones, that's, let's say, not a good banking practice. But senior debt is a deposit at the bank. And Investec as a bank, we're very happy because we say the SA government's like, if you think of Reg 28, it's your top asset in the market. Are there any other questions I can pick up? Kishore, you guys got anything that you would like me to pick?
Thanks, I'm done. I'm covered. Okay. No problem.
Excellent. And Ray, your side?
No, I'm fine, thanks. It was very interesting. Thanks very much.
Pleasure, thank you. And so, James, if there's no other questions, then we'll ring off. But as always, we're just a phone call away. Just let us know. Very happy to take questions as they arise.
Great, thank you very much, Japie. And between Graham, Grant, and myself, talking about the investment vehicles that are sort of better suited, we are also, more than happy to have those discussions. So yeah, thank you very much for taking the time out this morning, and hopefully we'll have a few more of these discussion sessions as things come about. But I will send through a recording of this and all the documentation to go with it. So if you do have any questions as you go through it, please do feel free to send through the messages to either us or to Japie, and we'll make sure they're answered.
Brilliant.
No, thanks, guys. Cheers.
Thank you very much.
Thank you.
Great.
Thank you very much, guys.
Thank
all
you,
the
everyone.
best, eh? Thank you,
everyone. Thank you, Japie. Thanks so much. Really appreciate it.
Absolute pleasure. Thanks, guys.
Thanks, James.
Good luck. Cheers,
All right.
James. Cheers, James.
Cheers, everyone.
Okay, bye. Bye.
Cheers.
Bye.
Bye-bye, Japie.